Back to financial statement analysis. In this video, we are going to learn how we are going to do the cash flow analysis. The main purpose of cash flow analysis is to find out the details of cash inflows, outflows over a specific period. These details further provide the insight in the liquidity, solvency, as well as the future performance and growth of a particular company. Internal parties such as accounting personnel, managers, company executives, as well as owners use cash flow statement to provide the details areas where the company spent the money than the other financial statements. It used for short-term planning and as well as to assess the liquidity. Sometimes if there is a negative cash flow, it can be used to determine whether the short-term financing is necessary. If a company is issuing dividends, they can use it to determine the dividend policy, whether how much we are going to distribute, whether we are going to increase the distribution as dividends, or whether we are going to decrease the distribution. Not only internal parties, but also external parties such as government, potential investors, creditors, lending institutions may use the cash flow analysis. They may use the cash flow analysis to assess the ability of the firm to manage the dividend policy. A potential investor may say how much dividend they will get, what is the dividend yield they will get, and the payout ratio. And the ability to generate the cash through its operations. Here the operations means the core business activities. If a firm is failed to generate cash from the core business activities, then there may be a huge risk at the end of occurring the negative cash flow. Then the payment of dividend as well as the potential growth may be hampered due to such situations. The next one is to assess the company's ability to meet its obligations. Creditors must assure that their funds will be recovered back. So the lending institutions as well as the creditors may seek the ability to meet its obligations. To provide the information about the effectiveness of the firm to convert its revenue into cash is another use. They have to go through how much cash will generate out of one worth of rupee sale. Then to anticipate the company's need for additional financing. If there is a negative cash flow, they have to forecast how to recover it back. So they can use the cash flow analysis to assess the additional financing need. Let's learn the key terms of cash flow. Cash means the cash on hand and the demand deposits. Cash equivalent means the short-term, highly liquid investments that are readily convertible to known amounts of cash. Cash flow is both inflow and outflow of cash and cash equivalents. Cash flow statement has three components: cash flow from operating activities, investing activities, as well as the financing activities. Operating activities include cash received from sale of goods and rendering services, cash received from royalties, fees, commissions, and other revenues, cash payment to suppliers for goods and services, cash payment and on hand behalf of employees. When it comes to investment activities, it includes the cash payment to acquire property, plant and equipment, intangible and other non-current assets. and cash received from sale of property, plant and equipment, intangibles, and other non-current assets, and cash payment to acquire shares or debentures of other enterprises, and cash received from sale of shares or debentures of other enterprises. Financing activities include cash proceeds from issuing shares, cash payment to owners to acquire or redeem shares of the enterprise, cash proceeds from issuing debentures, loans, notes, bonds, mortgages, and other short-term or long-term borrowings, and cash repayment of amounts borrowed. There are two main ways of preparation of cash flow statement that is mainly considered with the operating activities. In the direct method, it discloses major classes of gross cash receipts and gross cash. Mm, yeah, yeah, yeah. In the direct method of cash flow from operating activities, first we are going to take the cash received from customers. From that, we are going to deduct the cash paid to suppliers and employees. Then we are going to arrive at the cash generated from operations. For that, we are going to deduct the interest paid and income tax paid. Then we are going to arrive the net cash flow from operating activities. Let's look at the indirect method. In the indirect method, we are starting from the profit. If you are starting with the profit before interest and tax, then no need to add the interest. But if you are starting with the profit after tax, then you have to add back the interest and tax. So since we are starting from the profit before interest and tax, we have to add back the depreciation or the amortization. This is a non-cash item. Since the accounting profit are reduced by the non-cash items, they must be added back to the accounting profit to calculate the cash flow. Then we have to add back the losses or deduct the profit on sale of non-current assets. Then we are going to move for the working capital adjustment. So if there is an increase in inventories or receivables, we have to deduct it because it's a cash outflow. And if there is a decrease in inventories or receivables, we have to add it back to the profit. But when it comes to payables or creditors, if there is an increase in the balance of the payables, we have to add it back. And if there is a decrease in payables, then we have to deduct that value from the profit. Then we can get the cash generated from operations. From this, we have to deduct the interest as well as the tax. Then we can get the net cash flow from operating activities. Let's see what is the effect of operating changes in assets and liabilities. When the transactions that result in an increase in asset will always result in decrease in cash flow. And transactions that result in a decrease in asset will always result in an increase in cash flow. Transactions that result in an increase in liabilities will always result in an increase in cash flow. And transactions that result in a decrease in liability will always result in a decrease in cash flow. So we can see there's an inverse relationship between the asset and the cash flow. When assets are increasing, the cash flows are decreasing. When assets are decreasing, the cash flow is increasing. However, there is a positive relationship between the liability and the cash flow. When there is an increase, the cash flow always increase. When there is a decrease in liability, the cash flow is always decrease. Let's see the effect of exchange rate changes on cash flow. First, in the direct method, there is no need to make any adjustments for unrealized foreign exchange gains and losses. However, in the indirect method, the unrealized foreign exchange gains and losses are separately disclosed in the net cash flow from operating activities, unless the unrealized foreign exchange gains and losses are also included in the changes in operating assets and liabilities. Unrealized currency translation differences on items such as trade receivables or payables do not usually require such adjustments. Why? They are already adjusted to the changes in working capital lines. Currency translation differences that arising on the translation of foreign currency cash and cash equivalent should be reported in the statement of cash flow in order to reconcile the opening and closing balances of cash and cash equivalent separately from operating, financing and investing cash flows. According to IAS 7, the exchange rate used for translation of transactions dominated in foreign currency should be the rate in the effect at the date of the cash flow. At the same time, cash flow of foreign subsidiaries should be translated at the exchange rate prevailing when the cash flow took place. Now let's analyze the cash flow trends. There are mainly 9 ratios which used for cash flow analysis. First one is operating cash flow per net sales, cash flow adequacy, cash flow liquidity, quality of income, cash flow coverage, operating cash flow per cash dividend, cash flow margin, current liability coverage, and finally, price to cash flow. Let's look at operating cash flow per net sales ratio. This ratio is expressed as the percentage of company's net operating cash flow to its net sales. This tells us how many dollars of cash are generated for every dollar of sales. There is no exact percentage to look for. However, higher is the better. It should also be noted that industry and company ratios will vary widely. However, investors should track this indicator performance historically to detect significant variations within the company, and they have to compare it with peers in the industry to identify any deviations. It is also essential to monitor how cash flow increases as sales increases, since they must move at a similar rate over the time. Cash adequacy ratio is a liquidity ratio that measures the ability of a firm to meet its short-term cash payment requirements. It is calculated by taking the amount of cash from operations and divided it by long-term and fixed assets purchases and dividends. The cash flow adequacy ratio is used to determine a credit rating for companies. A cash flow adequacy ratio of 1 or above indicates cash flow are high enough to pay for the capital expenditure and dividends. Below 1 would indicate that they are inadequate for their operating expenses. If the cash flow adequacy ratio is increasing over the years, it is a sign that company is increasing its operational cash flow or reducing its operational expenses. However, if the cash flow adequacy ratio is decreasing, it is a sign that the company is increasing its expenses or losing its cash flow from operations. It is not advisable to use the cash flow adequacy ratio to compare the companies that are in different industries, since their operational models will not be the same. A cash flow adequacy ratio can be increased by increasing the company's sales or decreasing its expenses. Cash flow liquidity ratio only includes the most absolute liquid funds. The cash flow liquidity ratio measures how well a company can handle its short-term debt with its cash and other liquid assets. The cash ratio is more conservative than other liquidity ratios because it only considers a company's most liquid resources. It determines how successfully a company can manage its short-term debt. Normally, it says 20% of cash ratio is a good benchmark. If the cash liquid ratio is 1 or above, it indicates the most liquid funds are available to cover the current liabilities or the short-term debts. Below 1 warns of financial crisis. Cash flow coverage ratio is a liquidity ratio that shows the relationship between company's total debt and operating cash flow. This indicates that an organization has the sufficient cash flow to pay its scheduled debt payments. Cash flow coverage ratio can be used to assess businesses' creditworthiness. Managers can use this ratio before making crucial decisions like when to pursue or hold off expansion plans, how to improve their debt management strategies, or to determine whether debt resources are used properly for generate maximum cash flow. Normally, it says this ratio should be high as possible. The ideal ratio is anything above 1. When the cash flow coverage ratio is high, it shows that higher operating cash flow against its total debt. That means the business is financially stronger to increase its debt payment. The cash flow coverage ratio is low, shows that there is a good chance that the business will fail with interest payment. Hence, the business is financially weak. This generally means if they will go for the expansion plans, they have to stop it until the cash flow coverage is improved. When there is a lower cash flow coverage ratio, companies should go for refinancing or restructuring its operations to increase its cash flow. Operating cash flow per share is a ratio that takes the operating cash flow by adjusting for the preferred dividends during the report period and then divided by the total number of shares outstanding. Here, the operating cash flow represents the cash flow generated under normal business operations. So here, instead of number of shares outstanding, we can use the weighted average number of shares. For that, the common shares should be fluctuated over the given period. The better the operating cash flow per share, then we can conclude that company's financial performance is better. The company has greater ability to generate cash flow per equity holder. Operating cash flow per cash dividend can be taken by operating cash flow by dividing its cash dividend. It reflects the company's ability to pay current dividend from operating cash flow. If this ratio is high, it is a good sign of cash flow strength of the company. Operating cash flow margin is a key indicator of performance. It is a profitability ratio that measures cash flow from operating activities as a percentage of total sales revenue in a given period. It shows how efficiently a company is creating money out of its revenue. It is a useful method for assessing companies' financial health and capacity for growth. A good cash flow margin should be above 50%. It is a good indication that the company is efficiently converting sales into operating cash, which can be used to pay shareholders as dividends or buy back stocks. A negative operating cash flow margin means that the company is losing money. It is not able to recover the cost of production of its goods. One way to improve operating cash flow margin is to conduct a timely cash drive to collect all account receivables. However, this might be tricky because no company wants to lose its customers. However, the company can always work toward striking a balance between the customers, and they can insist the customers to pay on time. Current liability coverage ratio is also known as the operating cash flow ratio. This is calculated by taking the cash flow from operations and divided it by the current liabilities. The operating cash flow ratio is a liquidity ratio which measures how well a company can pay off its current liabilities with the cash flow from operations or the core business operations. This ratio demonstrates the ability of core business operations to generate cash that can be used to cover debts that need to be paid within a year's time. This liquidity ratio is considered as an accurate measure of short-term liquidity because it only uses the cash generated from core business operations rather than from all income sources. A ratio greater than 1 indicates good financial health. Hence, there is more sufficient funds to meet short-term financial obligations. If this ratio is less than 1, it shows that the business is not generating enough cash to pay its short-term or immediate obligations. So, they may be at a significant risk of bankruptcy. Price to cash flow ratio is calculated by dividing the share price by the cash flow per share. It tells the investor the number of rupees that they are paying for every rupee in cash flow that the company earns. It shows the amount an investor is ready to pay for the cash flow a company has generated. So investors use this type of ratio to describe the company's valuation with respect to cash. This ratio is qualitatively better than the PE ratio since it uses the cash flow instead of reported earnings, which can be manipulated easily. In theory, when the price to cash flow ratio is low, it means that the stock value is better and it may imply that the stock is undervalued in the market. Whereas a high price to cash flow ratio is generally seen as worse. It means that the company is overvalued with respect to its cash flows. Hence, a high price to cash flow ratio indicates that the specific firm is trading at high price but is not generating enough cash flow to support. The cash flow to net income ratio, sometimes referred as cash flow yield. It is calculated by dividing the operating cash flow of the business by its net income. The ratio is also used to indicate the quality of the earnings. The cash flow to net income ratio measures the ability of the business to generate cash from its operations. A proportion close to 1 to 1 indicates that the organization is not engaging in any accounting tricky intent to inflate the earnings above the cash flow. In general, a net cash flow to net income ratio is less than 1 to 1, indicates that the business take in less cash and cash equivalent than what it earns in profits. Whereas a net cash flow to net income ratio greater than 1 indicate that it take more cash and cash equivalent than what it earns in its profit. Now let's look at the difference between cash budget and the statement of cash flow. We know that cash budget can be prepared whenever we want. It's not a legal requirement. However, cash flow statement is part of the required financial statement that must be prepared and presented according to the LKs. All the public limited companies should prepare the cash flow statement according to the CSE requirement. Cash budget is a short term. If you want, you can prepare the cash budget for a month, for a week, or even a year. However, cash flow statement is a long-term one because we are going to prepare the cash flow statement for a year. In the cash budget, we are going to include the depreciation. However, in the cash flow statement, we are not considering the depreciation because there is no cash flow involvement in the depreciation. Now let's see how we are going to analyze the cash flow trends. A positive trend in operating cash flow indicates financial health, whereas a declining trend can indicate a weakness. If a company fails to achieve a positive operating cash flow, which means the company cannot remain solvent in the long term. A negative operating cash flow indicates that the company is not generating sufficient revenue from its core business operations, and therefore they need to generate additional positive cash flow from either financing or investment activities. positive trend in cash flow from investment shows a go-ahead for companies' future ambitions. It indicates how much of cash is using to grow your business and planning for long term. Whereas a negative cash flow in investment activities could be a warning sign that the management is not sufficient at using the company's assets to generate revenue. A positive financing cash flow indicates that there is a strong ability to repay debt and the return for the investors. If a company's cash is coming from normal business operations, that's a sign of good investment. If the company is consistently issuing new stock or taking out debt, then it might be an unattractive investment opportunity. Free cash flow. It is a measure of a company's financial performance. It is measured by the excess of operating cash a company has on hand after paying its capital expenditures and dividend. This excess can be used as per wish of the management. Free cash flow allows a company to pursue opportunities that enhance shareholders' value. For example, by increasing dividends, developing new products, paying off debt, and buying back stocks. So you can see the formula of calculating free cash flow. Why cash flow per share is better than EPS. EPS is the most popular profitability metric used by the investors and analysts to measure the number of profits allocated to its shareholders. It can be calculated by taking the net profit divided by number of shares outstanding. Whereas cash flow per share is taking the operating cash flow divided by number of shares outstanding. We know that earnings can be manipulated, such as if a company is entering into a 3-year contract, they can inflate the profit by recording all the 3 years lump sum in the current year itself, rather than distributing the revenue in all the 3 years. At the same time, companies can show the assets worth billions in their accounts but never exist, and charge heavy depreciation to lower their profit figure to pay fewer taxes. However, the cash flow present is the true picture. We know that in accounts and financing, we say that cash is the key. Without cash, the companies cannot see or forecast their future or pay their day-to-day expenses for survival. Now let's see the purpose of the financial statements and how the statement of cash flow had overcome the shortcomings of the other two statements. That is, the income statement and statement of financial position. We know that income statement present the revenue, expenses and earning for a given period of time. It shows the performance of the company over a given period. Whereas statement of financial position represent the asset, liability and equity at the end of the fiscal period. It's just like a snapshot. So it's take the position of the company at a particular date. Whereas the statement of cash flow represent inflows and outflows of cash categorized into operating, investing and financing. Neither the income statement or the statement of financial position provide the details of information on the cash flows. Therefore, The cash flow statement has overcome these shortcomings of the income statement and statement of financial position and reflect the liquidity position of the company with the calculation of cash flow ratios.